Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
G'day, hello everybody, and thank you so much for joining us today. Welcome to the Australian Property Podcast 2 Cents segment, where we take a plain English look at the big three property news stories of the week. I'm joined by mortgage broking king, Chris Bates. Hello, Chris.
Pete, absolutely love this time of week. Good to chat, mate.
Yeah, good time to recap on what's been doing the rounds in the media. Before we crack on to that, how was your long Easter weekend?
Oh, I was meant to go camping, but I jarred my back playing football, which was
Getting old.
Sort of pleasant. Yeah, exactly. Getting old and pleasant surprise, to be honest. My daughter wasn't very well as well, so it wouldn't have been fun camping with a sore back and a sick daughter. And being a double dad. So yeah, we missed camping. We just relaxed around the beaches, doing the usual beaches life. What about yourself? What'd you get up to?
Yeah, I feel your pain as a long time sufferer of sciatica on the right side of my body. It doesn't get better as you get older. We stayed put for Easter actually in Noosa, but of course Christmas and Easter are the two weekends really in Noosa where everything goes completely nuts. But all the kids just wanted to stick to their usual routine, going to the same burger places and so on. Of course, Hastings Street absolutely rammed with people, largely from Sydney and Melbourne. So pretty busy, but it's been a glorious weekend. So happy days.
Very good. What's happening on the work front?
I guess this will feed into one of the big news stories of the week. We're suddenly getting a lot of people who inquired about buying property 3-4 months ago, suddenly resurfacing and saying, right, let's get on with it. So I think a lot of that ties back to media headlines. Even as we record this today, there's articles leading the media about the market having bottomed. So it's really people just reigniting their interest in the market. How about yourself?
Yeah, similar. When we had a guy last night who, years ago engaged us, went quiet, as clients sometimes do. Life takes over, right? And they come out of the woodwork. And you're right, a lot of it, that's down to sentiment. They finally feel like they need to take action. They're a bit more impulsive sort of buyer, I guess. They're waiting for the reactive sort of market change. And I guess so that's definitely something we'll have a good chat about today.
Yeah, so if you're not familiar, every Sunday morning at 7 a.m, you'll find our 2 Cents podcast episode just waiting for you in your podcast player. We have a bit of fun and talk about the main three news stories of the week. So the three we picked out this week, firstly, the role of sentiment. We've seen a couple of big bank surveys out this week. So firstly, the role of sentiment and why that matters for the housing market. Secondly, there was a news story that caught our eye about the Sydney suburbs where home buyers don't leave. And it was some quite detailed analysis from a good friend of the show, Simon Kustenmacher, talking about the trend towards people owning properties for longer. And certainly parts of Sydney is isolated there. So we'll talk a bit about that. And then thirdly, so many news stories about the housing supply crisis and how that is going to be solved. So it wasn't really just one story. That's kind of been all over the media this week. So those are our big three topics. Chris, let's start with sentiment. So I guess in the news this week, Westpac put out its monthly consumer sentiment survey, big rebound because interest rates were on pause. The bit that caught my eye really was the sub-indexes for things like time to buy a dwelling that bounced back sharply in March, and particularly house price expectations. That index is up 43% since November. Another massive increase this month, about 16.5%. So I mean, that more or less ties exactly back to what you were saying last week, which was the best buying conditions, well, on this index seem to be around sort of November 2022, when people were really fearful. But that since that time, expectations have absolutely rocketed back.
Yeah, I think this last week, I sent that article to you, I think it was like Thursday or Friday last week. I think we should talk about sentiment next week. And over the weekend, we saw the Sunday Telegraph have a full spread around house prices are basically going to boom. All the news, the Channel 9 and Channel 10 and Channel 7, prop data, CoreLogic started to release quarterly data that was, showing really positive signs for Q1. And that sentiment had really shifted. And we were noticing it on the ground, that our clients were a bit more anxious, a little bit more urgency, and we're not fearful of further price falls. And so we could feel that sentiment had already shifted. And I think the start of it was all the way back last year. The buyer's attitude started, and I wrote a lot about this on LinkedIn, actually. Buyer urgency is increasing. You've got to be careful trying to time the bottom. You're going to miss it. And I think that's what sort of happened here. It's caught people off guard. The property market and markets in general often do this. There's the herd thinks something's going to happen, and then the market behaves in something differently. And that you can go through every year in time, and everyone's usually shocked what happens, to be honest. So I do think sentiments really shift, and that brings in a lot of buyers. And I think what we'll talk about today is that sellers don't react as fast to the market shift. And so I think what we're seeing is a lot more buyers are going to want to enter now because they believe the bottom's here. The media is telling us that. It must be true. And all the buyers are going to pack in at the same time, or a lot of them, under a very small number of listings and quality properties out there on the market. And unfortunately, those two, demand and supply aren't matched. And, a lot of people are competing over a small number of properties, and it doesn't take a rocket science to figure out what happens then.
Well, that's right. There's two analogies that Ben Kingsley from Empower Wealth I've heard mentioned before. One is the concept of like the pent-up demand. It's like a rubber band being stretched back. When you get property downturns, so many people just sit on the sidelines, don't want to make a decision, difficult to buy in a falling market, don't want to catch a falling knife, and all of those old adages. But then when the market turns, everybody comes back together. And as you just touched on there, the sentiment changes much more quickly than the number of properties for sale, particularly this time of year, because we're going into the cooler autumn months when people don't list. And even since a week ago, when you sent me the email saying, let's cover sentiment this week, well, there's, Channel 10 led with a big piece on the market having bottomed, headline in the Fin Review today. SQM Research is predicting price gains. The sentiment has turned pretty much on a dime. Now, I guess the one caveat here is that a lot of this has been driven by the pause in interest rates, but it is possible, I guess, that we could see interest rates still being ratcheted higher again. So I suppose that's the one thing that could throw a spanner in the works.
Yeah, and I think some of the property bears and, some people have been very good at forecasting the market in the past and sort of coming out swinging still and saying, look, there's a lot of pain still to come with the fixed rate interest cliff later this year. Rates could still go up higher, etc. But I think the market's been extremely resilient in the space of, 3.5% increase in interest rates plus a 35 to 40% reduction in borrowing capacity. And the market's potentially, not that we would talk about the market, but the market might only be down, say, 10%, let's call it. It has been surprisingly resilient. It's starting to get, that pent up demand on a small number of listings. And so, we obviously we need a caveat because there could be potentially some new data that comes and shifts sentiment back down, or inflation figures are being really stubborn around the world and rates are going to have to go higher than they expect, or, there's a recession coming and there's unemployment really starts to spike. So there's things that, not to say we're out of the woods, but, the signs are showing that there's enough demand to support the number of listings on the market. And that's when the property market, you always got to remember, it's about the marginal buyer. If everyone tried to sell their properties right now at the same time, absolutely, they wouldn't hold their value. There wouldn't be enough buyers willing to pay. But if a small number of properties are selling and there's a small number of buyers willing to buy at current prices, then that holds prices. And that can potentially push up prices if you've got competition. So the marginal buyer theory is really playing out in this downturn.
Makes sense. I think the thing to remember, and this goes back to an old Ben Graham quote, that in the short run, the market is really a voting machine. So i.e. it's driven by sentiment. But over the long run, it's going to be driven by fundamentals. So he said in the long run, the market is a weighing machine. And that is why if you're looking to buy property as an investment, you generally try and focus on those aspirational landlocked areas where household wealth and incomes are rising over very long periods of time. I think in the short term, as we've seen this week, things can change very quickly in terms of sentiment. But those fundamentals, well, that's really what's going to drive the long-term results. And that's why we try and focus on those more sort of aspirational, gentrifying areas where there just isn't the available land.
And I think this really leads into article number 2, Pete, because this is one of the top, I guess the thought processes behind understanding the property market is not just understanding the number of properties available, the number of properties that exist, the number of properties that are actually for sale. And Domain did an amazing article. I love reading anything where it explains that people are living in their houses for longer. And I think in Sydney, back in 20 years ago, we'd live in our houses roughly around 5 years. That's doubled to around 10 years. And so what that means is that we're selling once every 10 years, not selling once every 5 years. So the turnover rate, the number of people selling per year, is basically halved, if you say it like that. And so that means that the chance of buying a property in that suburb is actually halved, if you want to think about it like that. And so that means there's a half the number of properties available to buy each year than there was, say, 20 years ago. Now, obviously, there's more properties, etc., but there's also more people. And what this article really shows is that there's lots of reasons why people are living in their homes longer, which we'll have a chat about. But what it shows is that actually there's less supply available every year because less people are living in their homes for longer and they're less likely to sell. What was your take on that article, Pete?
Yeah, so the stats they came out with, median hold period for houses has jumped from 5.3 years in December 2002 to 10 years in December 2022. So in 20 years, it's doubled. For units, they've gone from 4.3 years to 8.3 years. And the biggest increase in hold periods was for houses in the inner west, from 5.4 to 11.7 years, so basically doubling. And the longest hold periods for houses overall was in Sutherland at 12.3 years. Now, this does make sense to me conceptually. So about 25 years ago, I actually did live down in the Shire, Sutherland Shire. And I think, thinking back, what people did back then, they paired up. They bought a first unit together, maybe for 4 years, as the data implies. And then at that point, they trade up, they get married, trade up and buy a house. These days, though, some people aren't buying their first apartment until their mid-30s anyway.
Yeah.
But also, I think once people get on the housing ladder, they're very scared to sell. And they basically just land bank. They'd much rather stay in place and renovate. Baby boomers, they should downsize, but a lot of them are just preferring to age in place. And there aren't many alternatives, even for those who want to downsize. So I guess there's a whole range of factors, but maybe the biggest one is stamp duty.
Yeah, stamp duty is obviously part of it, but even if someone can afford to pay, stamp duty, which is a lot of money, it's maybe about 5% of the next purchase, right? So, and then you got to pay, 2 to 3% to sell a property, 2% for the agent, maybe 1% to tidy things up and style it, etc. So your transaction costs are maybe, 8, maybe up to 10%, depending on, the condition of the properties and small repairs that you might need to pay on the new properties. So it's a lot of money that's just sort of gone in just doing the transaction. But also you have to take on the additional debt, because usually when you're selling, you're sort of upgrading. And I think the jump between houses and apartments has really grown on people, but also the jump between a better house than what you've got. That's another big jump. And a lot of people are saying, well, I'd love to do it. But the transaction costs are going to kill me. But also, I'm not sure if I want to go into all this debt, because maybe you're right. They're starting the home ownership journey a little bit later. Maybe they're like, this will get us through the next 5 years, through the kids through high school. Maybe we can just make it work rather than going into a lot of debt. And people being a bit more. And maybe they also find they can't find those properties because people are living in those properties longer. And so it's even harder to upgrade. So I think the apprehension to the debt's definitely there. We see in boom times that goes, when rates were 2%, people were much more willing to upgrade because they also thought it was a good, financial decision because the market's booming. So we would have made more money if we upgraded. I think another thing is the tax settings on lots of different ways. In the retiree space, you can get the pension and have a $3 or $4 million home if your assets are under a certain amount outside of your home. I think that's a big part of it. Your home grows tax-free. There's a lot of incentive to keep your parents in their home if they also want to do that. Because that money is going to grow tax-free for your inheritance. So there's a bit of a play there because there's no sort of intergenerational tax. So there's lots of settings where I think people are also living longer. I mean, when I was an advisor, I remember seeing a stat many years ago is that, if two husband and wife get to 65, there's a 50% chance that one of them was going to live to 92. And so we're all living longer. We're staying in our homes longer. It's not exciting for them to go to aged care. There's been a Royal Commission into some of the issues there. So, what we're seeing is a freezing up of the housing market where people are stuck in homes, not just because of stamp duty, because of the tax settings, because of preferences, because of kids, etc. And people are just living in their homes for longer.
Yes, and it's I suppose one of the things it does do is for your strategy for young people. It's quite a big decision to be made now. I mean, the traditional model of sort of building up housing equity was you buy your first home, and then when you can afford to, you trade up capital gains tax free to a better home, and then maybe in 5 or 10 years' time a better home. Pretty much what my parents did, and most of the people of their generation. These days, though, as you said, well, firstly, the gap between house and unit prices, especially in Sydney, Melbourne, Brisbane, there's a big construction boom for apartments around a decade ago. Well, that gap has got bigger. And so for some people now, if they're not really sure where they're going to be in 5 or 10 years, people are going down this route of effectively rent vesting. So potentially renting where they live and then building up a portfolio of investment properties around the country. So it's a trickier strategy or trickier decision than it used to be, especially with people changing jobs and careers more often than they used to. And if you can't afford the home you really want to live in, then some people are going down that different route, Chris.
Yeah, and I think the big story here for people investing in property is you want to buy into areas where people are staying put, because they love the area. They're usually going to renovate the homes. The places are gentrifying. The community potentially is stronger. Families want to stay there rather than areas where people are very transient and people are buying and selling and renters, etc. Growth usually is in better areas where people aren't selling. And so if these stats continue, what happens if people are living in their homes for 15 or 20 years as an average in 20 years' time? All that's really going to mean is it's even harder. There's less properties available for sale in these suburbs. Because if everyone's selling every 5 years, then everyone, there's lots of properties coming on. Everyone will be selling every 5 years, but if everyone's selling every 15 or 20 years, it's showing that these properties, these areas are really tightly held. It's very hard to buy into. And then the marginal buyer theory, as my first point, really starts to play out. So watch this space, because if it continues longer term, what you've got is actually shrinking supply in a city where there's growing demand. There's shrinking a number of listings in the suburbs that people really want to live. And there's more and more people who want to buy in there. And so, yeah.
It's a bit like the old game of Monopoly, people buying up the best spaces on the board and just land banking them. It's been a problem in the eastern suburbs for forever, especially in Australia with no inheritance tax or death duties. People just basically land bank for the long term. And if there aren't the incentives in place for people to downsize, then often they don't.
Yeah, and that's right. And a lot of people there's not been great options to downsize. There's hasn't been an amazing option for them to stay within their community. There's a real lack of, bigger apartments, let's say, that they want to move down from a house into. And so they can't build their apartments fast enough to satisfy the housing demand. There's no land tax on your house, when it's your home. And so they can sit on an asset that, that's got a lot of wealth there because, it's not costing them a lot of money just to stay there. And so I think a lot of these things are going to come on the table over the years, just like superannuation became a big point recently where they're targeting bigger super balances. Maybe we're going to start to see some other tax to, for retirees that are sitting on homes that are, still getting the big pension and not paying any land tax. You could watch this space longer term, I say.
Yeah, and this actually ties into our third story, which is the housing supply crisis and how that's going to be solved. So we've got record high immigration at the moment. I think some of that was a catch up anyway from the border closures of COVID and those pandemic days. But the Treasury now forecasts an influx of 650,000 migrants per the AFR this week between this financial year and the next, as the reopening of Australia's borders prompts the return of students, working holiday makers, skilled migrants, and of course, we've got permanent migration ramping up again now as well. So I saw, caught my eye this week, that asking rents for units in Sydney up 37.7% per My Housing Market. SQM Research had them at over 30%. Melbourne and Brisbane not far behind. So obviously there's a chronic shortage of rentals in the big cities now. And yes, there's still a lot of housing under construction around the country, but we've got a real supply shortage. So, Chris, how do you think this housing supply crisis actually gets solved?
Yeah, I do really feel for the building development industry right now. They had a real multiple, 1 in 100 year events, right? And, you've seen big builders like Porter Davis and lots of others have gone under. So PBS was another big one a few weeks ago. These are big construction companies that are producing a lot of new properties or dwellings for the Australian society. And it's not giving confidence to other developers and builders out there to take on risk and to hire. And a lot of them didn't make that much profit in the last few years because they were all signed up to fixed rate building contracts, fixed price, due to the home builder that the government used as stimulus in COVID times. And that had a lot of demand and a lot of competition between the builders. And so they were very tight margins on those contracts. And then they had all the issues with the weather. How long a build takes is a huge cost, holding costs, cleaning up the site, getting access to materials. We know there was so many articles around timber and steel and concrete and et cetera, even just getting the electronics, are big issues as well. And then we had massive labor issues. A lot of our workers potentially went back home to countries, in COVID. And then there was just a severe shortage of workers. And so all those have really made the building industry be a real dangerous place. And some developers aren't surviving and some builders. And I'm not sure if I was a bank, I'd want to be lending much money to these people as well. And if credit dries up to them, well, they can't take on risk even if they want to. And they can't. So it's going to take them a long time to catch up to the building numbers that we need as a society. If we're going to 650,000 people are going to move here in the next 2 years, we need to put them somewhere, right? And we've already got a rental crisis and a homeless problem. So it's not a great picture at the moment with lots of demand increases. And there's not this, the hundreds of thousands of new buildings that are going to get built in the next few years that are going to really even it out.
Yeah, I think one of the things in economics is you find that shortages invariably are followed by gluts. It doesn't feel like it as we sit here today, but I think if you went out maybe 3 or 4 years from now, there'll be a range of things that actually help construction to catch up and then eventually flood the market again. But it will take a long time. I don't think particularly medium density and higher density properties, they really take 2 or 3 years to get out of the ground. I think the things that will see the supply picking up again, build to rent, I think that will become more popular. There's a lot of capital, billions of dollars going into that sector. I think at some point, maybe non-resident or foreign buyers might be allowed back into the market without the stamp duty surcharge. That's really dried up the new supply in recent years, and maybe some other incentives. But I think the biggest one is simply that prices will go up for units. I think there's just such a shortage. News article yesterday, rents going up 70% in a unit block in Tamarama in Sydney. I mean, we're seeing that all over Sydney at the moment. I think generally rising prices is what brings supply. And I think you'll find after a difficult period, I think for units, I think in Sydney and Melbourne, you see prices go up, and that will actually eventually drive the new supply. But it will probably be 2026 or 27 before we actually see it.
Yeah, you made a good point around the sort of foreign buyers there, around looking a gift horse in the mouth. When the property market was booming in 2016, 2017, to calm society down, they said the problem is foreign buyers. We're going to put a big surcharge on them. They've got to get everything reviewed, and the Foreign Investment Review Board, etc. And they were really the problem. That's why prices are really expensive. And I think what we're now saying is actually, no, we need foreign buyers. The reason we've got a rental crisis is that we need more investors. And investors have been the fall guy for the last few years. And I think getting the foreign buyers back into the country, it's going to win their trust again, I guess. I think you're right. I think we'll see some changes there with maybe the cutting of stamp duty surcharges, etc. You're right. Developers need to make a profit, right? So they're not going to start to do these, push the button on these projects until they know they can sell them. And that will be after price rise increases in terms of sale prices. And so, I think the foreign buyers developments will come through, but ultimately you've got a rental crisis right now. And I think the rental crisis, if you, for example, can't rent and you think that, when vacancy rates are under 1%, your natural thought process, and I've had this multiple times in the last few months, is it's so hard to rent. My rent's going up. I should just buy. Why should I pay increasing rent when I could pay a mortgage? And if that person's also thinking, actually, interest rates aren't going up anymore, interest rates may go down, and property prices are going back up, they're already more enticed to become a buyer rather than a renter. And so rental stress will actually lead to more buyer demand, just because, security and stability, and it makes more financial sense when rents are higher. So I think that's what we're also going to see. That's going to be a tailwind to support property price growth, is rental stress.
I think so. And also when rents go up too much, then people start looking at alternatives. They stay with parents, they buddy up, and share housing will make a comeback. It was largely absent for 2 or 3 years. So I think even for rents as well, it may not feel like it right now, but as the supply starts to come back online, we'll start to see rents tapering off a little bit. It's just at the moment, we're probably in the eye of the storm a little bit. There's huge migration happening, record high student arrivals over recent months, and just nowhere for people to go. But
yeah,
a lot of these problems, they do get fixed in time, even if it doesn't feel like it right here today.
There's a lot of talk around the build to rent sector, and I absolutely love that sector. To provide more you're bringing more private investment into the residential property market and commercial and super funds, etc. But from my numbers, and I've been looking around at this bit, maybe there's around 30,000 dwellings right now that are planned, right? And the property market's got around 11 million dwellings, right? The rental market's got over 3 million dwellings. So even if all the build to rent projects that are planned went ahead, and even if it doubled or tripled, it's still a real fraction number of new listings coming onto the market, which we desperately need. And so I think this is the problem we've got at the moment, is that investors haven't been encouraged into the market for 5 to 8 years now. Since about 2015, 2016, they were really pushed out of the market because of issues around borrowing capacity and interest only, etc. And unfortunately, that's what we need to, reduce the rental supply. Rental stress is more investors coming in the markets, whether it's locals, foreign, or things like build to rent. Ultimately, that's what's going to provide more options for tenants.
Most Aussies don't like to buy new units, which is why it's been so difficult to make projects viable in recent years without the Chinese mainland investors or other foreign buyers. I think on the build to rent front, I think there's always a bit of a stock versus flow thing here. As you said, there's 11 million dwellings in the country, and 30 or even 100,000 units doesn't really move the needle. But in saying that, you do often find that a lot of these projects hit the market at the same time, and that brings more choice. Just, you can see a glut. We did see that in some of the capital cities with those high-rise towers about 7 or 8 years ago. So we'll get something similar, but it's probably a few years down the track, just given the long lead times on some of these high-density projects.
I think you made a really good point there around the locals not wanting to buy the high density. I think go back 10 years ago, I think naively, and the government was also a big part to play in this. We're encouraging investors to buy new property, and they will do again. It's absolutely you'll see grants to buy new apartments. You'll see all sorts of things like NRAS and all sorts of DHS housing, etc. So ultimately, the government want people to buy new property because all the tax they get through those new properties, development tax, stamp duty, GST, it goes on and on and on. And even supporting the construction industry for jobs and all the taxes they make there. But I think the consumer, the investors, now switched on a little bit and gone, is this really the best investment for me? I know you're wanting me to go down that path and you're giving me all this incentive, but what's the returns like in the high density space? And there's been a lot of media around building issues in cladding, water issues in high density. There's a whole building commissioner in New South Wales. There was a fire in Melbourne, etc. But also people, I think, realise now the investment returns. A lot of investors have been burnt. They've gone down the high density route and they've gone, hang on a sec, I've had this apartment in Brisbane for 10 years and it's gone from 400 to 450. I've had my apartment in Melbourne for 15 years and it's still the same price. I've lost money in Perth for the last 15 years on new properties, etc. And in Sydney, a lot of the new properties didn't go up when the rest of the market boomed the last few years. And so I think a lot of the investors don't want to go near the high density space, which is where we also need the most investment for rental stock. And so, through listening to this podcast, you'll learn things like that.
Makes perfect sense. Thanks, Chris. So to summarize on the big 3 property news stories of the week, the role of sentiment. Well, sentiment is really turned on a dime. You'll see that in the headlines. And the reason that's important is because in the short run, the market is really driven by sentiment. It's a voting machine, and we've seen that change very quickly. I think these indexes are sometimes a bit weighted towards Sydney and Melbourne, and it might not be reflective of what's happening all around the country, but certainly at the headline level anyway. And for the big capital cities, sentiment has turned very quickly, with the one caveat that interest rates might still go a bit higher from here. Second story of the week, Sydney suburbs where people don't leave. I think increasingly people are taking a longer-term view, longer-term hold on properties. I think this, for us as individuals, just means you've got to think a bit more strategically when you start out. I think people used to focus purely on just getting on the housing ladder. But these days, even a first home buyer needs to think a bit like an investor and have some kind of strategy, even if you have to adjust course along the way. And thirdly, the housing supply crisis. So I think over time, this will be solved. Build to rent might be a part of that. We might see foreign buyers coming back. I just personally think you won't see big unit developments getting out of the ground until unit prices rise for Sydney, Melbourne, Brisbane. That's my take on it. What do you reckon, Chris?
Yeah, I think you've done a really good summary there. And I think, a lot of people listening to this will be first home buyers. And absolutely, we spend a lot of time as a business educating them on the first property is actually the most important one. It's not a case of just focusing on your lifestyle. It's also trying to focus on what's going to, create wealth, I guess, for you as a family to give you more options down the line. And it's your biggest opportunity is your first property, etc. So I think you hit the nail on the head. You can't just try to get on the ladder, because usually the people who have thought like that, if that property hasn't done what it needed to do, is really they get prisoners in those properties, and they really fall behind and get limited options rather than more options in the future. So, I'm looking forward to next week, Pete. I think there's lots sort of coming down the line. It's the New South Wales stamp duty exemption. I think we're going to get some news around maybe when that's finishing. I think that's creating a bit of anxiety in the market. And we look forward to seeing what the media whip up next week.
Oh, there'll always be something. I remember reading a news article years ago about the latest fad. There was yo-yos, and then there was video games. But it's like music; it never goes out of fashion. And Australian property, well, there's not many weeks go by without a few big ticket news items. So we'll have no shortage of stuff to talk about. Thanks so much, everyone, for tuning in. As always, please do send us your property questions via the link in the show notes, or even if you just want to say good day. If you want to contact Chris with your mortgage questions or just questions in general, camping expert, all-round guru, he can be contacted at Wealthful or Blusk. And if you want to get in contact with me, my daily blog, Pete Wargent Blogspot, is probably the easiest place to find me, but also on social media. So, Chris, thanks so much. Always enjoy these chats, and looking forward to seeing you next episode.
Absolutely. Look forward to next week, Pete. Enjoy the
Cheers,
weekend.
Chris. Cheers, you too. See ya.